I'm Steve Savant, host of the Business Insurance Zone. Today and all this week, we're going to have Sheryl Moore, the #1 authority in index universal life and index annuities on our show. She's going to be talking about illustrations and proposals, exposing the games that we play in this arena. You won't want to miss this show. Sheryl goes off the guardrails. You're going to go to school today. Welcome to the Business Insurance Zone. Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, brokersalliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Well, our email address is thebiz@brokersalliance.com, or you can call us toll free at 1-800-290-7226, extension 147 for any quotes or questions you have on life insurance, annuities, DI, LTC, and group pension plans. And remember, I'm not a tax or legal advisor, so before moving forward with anything you hear on our show, always check in with your CPA or attorney. And of course, if you're a registered rep, FINRA, you need to check in always with your compliance officer before going forward with anything you hear on our show. Today, with day 3, with the goddess of all that is indexing, Sheryl Moore. Sheryl, welcome to our show.
Thanks so much, Steve.
Sheryl is the founder and creator of Life Specs and Annuity Specs, which of course we're tomorrow, remember, Thursday and Friday, we're going to be in on annuity, all over annuity indexing, which is there'll be a lot of controversy on that show. You won't want to miss it. Yesterday, we talked about crediting methods. I think we debunked a lot of myths. We should have called the show Mythbusters, because we went over and above talking about crediting rates and talking about a whole nother controversy. And today, in segment 1, we're going to get into it. And a lot of people say that I'm opinionated. If you read my blogs, my articles are all over the web. People say, Steve, you're slanted, you're opinionated, you got your own way of viewing things. If you think I'm opinionated, you've come to the Business Insurance Zone today. Sheryl is out of her mind.
Yeah.
And here's what we're going to talk about today. We're going to talk about illustration crediting. Now, I'm just looking at one carrier, right? And I'm looking at all their different ways they credit. Mm-hmm. And then I'm looking back to get my illustration rate so I can put the best possible face on an actual number. Now, that's what I thought I was doing.
Right. Well, I'm going to back up a little bit, Steve, because I will say illustrations on index life are the #1 most confusing thing to agents that haven't written index life before. Mm-hmm. Because they don't know, what is this illustration about? With current assumption UL, my credited rate is 4.5%. That's what I'm illustrating at. With VUL, I illustrate at no higher than a 10% gross rate. Right now, most BDs are looking at 7-8% max. Mm-hmm. What do you do on index life? Well, on index life, what the insurance companies, by and large, have said, we're going to take a historical look at whatever the index is that we're basing our interest off of, and assume a 0% floor and a cap of X percent, and see what would that rate be based on that historical study. We call that a look-back period or look-back method. And there's 9 different look-back methods in the index life market today. There's a huge lack of standardization when it comes to this issue. I feel very strongly about it with my background in illustration software development and in helping insurance companies with class action lawsuits related to illustrations. So you can count on me for a controversy on this show.
Yeah, I'm thinking about, I've been in this thing almost 30 years. I would say with all humility, I'm one of the top 10 illustrators in the United States. There are people in different other distribution wholesalers like Brokers Alliance that are excellent. And if I can't promote them on the air because, hey, they don't work for us,
Right.
But they're excellent. And I grew up with the best. I've been competing against the best. So when I start doing illustrations and indexing some years back, I was so confused on the issue of look back alone. That alone, I'm like, well, how did you calculate that? And then on top of it, they're just doing the look back on the S&P, not what their investor, the guy who's doing the short, the puts and the calls, but they're just doing a global look back. They're not looking back at what they did. personally, right? And I think from company to company, you're going to get different players. There's guys that are excellent at options, and there are other people that haven't done so well.
Well, this has been a great area for cherry pickers. That's how I like to put it. But I'll tell you that the one thing that I've been working on staunchly since starting my company 7 years ago is working with regulators to get standardization and uniformity in the area of illustrated
You're
rates.
dealing with regulators?
Oh, I work with regulators all day long, Steve.
And like give me a regulator.
National Association of Insurance Commissioners. I work with them.
NAIC.
Yes. ACLI is an entity that I'm working with on illustrated rates. I can't participate in their meetings because the American Council of Life Insurers is for home offices only. But I've helped to provide them with information so that they are actually spearheading the illustrated rate issue right now. And they can do it a little bit more quickly
I think
than
I should be
NAIC.
your surrogate substitute for that meeting since you can't participate.
There, I'd love that.
There it goes. We'll put my name in there.
All right.
Well, what I'm looking, you said, and I totally buy into this. There are so many methods in calculating the 30-year look back, the 20-year look back, whatever it is, and then on top of it, some of my carriers weren't even playing in this space at that time.
Right.
I don't know how they would have approached it in the day. So am I, like, for example,
and you don't even know what the option cost would have been in the day.
Right. So I'm trying to figure out some kind of legit number that I can put down. Now, I'm looking at one carrier here on my list, and they go from anywhere from 8.3 down to 7.1 in their lookbacks, depending upon the indices.
Their
and-
assumed
right.
illustrated rate.
All right. So if I actually, on one hand, I kind of feel like, well, I did actually earn this. So can't I put it on my illustration? Or am I just being conservative because I think, hey, the world has changed. The economy of the world is a little bit less than it used to be. The debt issues now, everybody's dealing with it, so nobody's going to be, the consumer section of that is not going to be very aggressive. So I need to pull back on my index. Now, one of the things you said Monday, and this is why I want to say, well, that people say, well, that matters. Why don't you just do current company, UL? But we've noticed that at the very least, over a long period of time, index is still going to beat whatever the current interest rate is by 2 points.
Right, 1 to 2%. It's
right.
going to beat out traditional fixed UL.
So whatever it is, we know it's the long haul way to go. It's going to beat the current interest rate environment and basically historically. But I'm always, what number? You said cherry picking. This is like going to the store and just looking at who advertises better. Can I tell the difference between the generic can of peaches and Del Monte, a brand name? You know what I'm saying?
Steve, what this really comes down to is not what is the company's illustrated rate. That's not the most important thing. Although in our distribution, we've relied on illustrations so heavily to get the sales, and whoever can show the highest amount of income is who gets the case, or whoever has the highest cash value at age 100 gets the case. I'm going to be the one out there saying, you know what? Whatever happened with underselling and over-delivering? Have you ever heard a policyholder say, I'm going to go with this other guy. I appreciate what you did for me, but you gave me too much.
Nobody says that.
Nobody says that. But you know what? Being conservative on the illustration is scary because you think about losing the case to some other guy who
Right.
shows a higher rate. Realistically speaking, what you need to be looking at is the contractual guarantees in the contract. Okay, what is the current cap? What is the lowest they can ever drop that cap? Do I feel that the rate that they're using for their illustration has integrity? Do I think it's sustainable? Do I think it's a realistic expectation of what my policyholder can expect to receive every year?
Well, now you just bring up a huge question then. What is the second year rate, the third year crediting rate? I have noticed a propensity among certain carriers. They have huge advertising on the first year, and then they do not. I don't think they're very good for consumers.
No.
Help me on this.
Well, that's one of the things I'm most sad about in this business, and it's not just index life, Steve. This really has developed as a change from using a career distribution for insurance products to using an independent agent distribution. And by introducing, the third-party marketers and such, what we've done is reduce the cost for the insurance company, but they've also had to bail out in terms of competitive pressures. Well, how can they get the agent's business if the agent can sell for 20 different insurance companies? Offer the highest rate. We know that's how they can get their attention. Well, what if this guy over here is doing something shady by doing bait and switch on his renewals? Well, in that case, they're going to have to succumb to the competitive pressure.
Does this software program that you've developed and that we've been using, does this actually address that? Second year rate, third year rate, the repricing?
Well, I'll tell you. In my 13 years of doing competitive intelligence, Steve, That is the number one most difficult thing to get your hands on. We don't have that in the system. I do have anecdotal information. I have actual policyholder annual statements. But what you need to know and what your agents at Brokers Alliance need to know is if they can't get the insurance company to commit to putting their renewal rates in writing, maybe there's a reason why.
Yeah, I think this is going to become the classic new due diligence issue of the 21st century in our decade, because people want to know, what am I getting into?
Right.
And I want to be able to with clarity and with the proper caveat, say, buyer beware. Here, heads up here, here's exactly what's going on in this contract, and here's what the second year and the third year, I want to see the commitment of the carrier to the client and make sure that we're getting what we think we're getting.
Well, and the insurance agent wants to know that he's avoiding an uncomfortable conversation with his client after the policy's been issued.
When I look at illustration rates, I know everybody predominantly is at the 8% rate. You have a problem with that?
I do have a problem.
Now remember, I told you she's opinionated, so let's talk about 8%.
Well, okay, the reason I have a problem with that, what do you think is the average fixed UL crediting rate today on current assumption UL?
Half that.
Yeah, I'd say 4.5%.
Yeah,
Do you think that's
yeah.
fair? Well,
Very.
an indexed UL is price to return 1 to 2% better than traditional fixed UL.
Okay, stop. Let's stop right there. It's priced. Now, I think that's a big heads up for all of our producers listening. The mechanics, it's structured really to do, I hate to say it because I hope this isn't too controversial, but to do really no better. The design, it might, but the design in itself is to price about 200 basis points over whatever the current is. That's what I just heard you say.
It is priced that way. Now,
Okay.
sometimes, do we get double-digit gains?
Well, sure.
Absolutely, because we can't tell what the market's going to do. Neither can the guys who price the products. But if you look at current assumption UL and the fact that it typically has a 2% floor, we're talking index UL, which has a floor of 0. So what we're doing is essentially taking that money that we would have spent on the floor and adding it to the upside potential.
Well, I just want, when I do our illustrations, and I've been illustrating for a long time, and I consider myself really decent at it, and I want to be able to put on what I think are actual numbers, or at least get me in the game numbers. And now we're talking about maybe knocking that 8% down to 6 to kind of make it more legit. When we come up in our next segment, we're going to talk about a whole nother area, because this relates to it, is policy loans, because I want this cash out of my contract.
Right.
And are all loan provisions the same? Oh my gosh, not. It's all over the board, and we're going to talk about it when we come back with Sheryl Moore, the authority on indexing life insurance. I'm Steve Savant. You've been listening to the Business Insurance Zone. When we come back with Sheryl, we're going to get into distribution with policy loans. Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new. Well, welcome back to the Business Insurance Zone, the talk show that focuses on insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. I just want to remind everyone you can watch this show and all our shows all out broadcasting in HD 1080p on Vimeo, YouTube, Facebook, LinkedIn, Twitter, and of course our on-demand section in brokersalliance.com. Our email address at thebiz is thebiz@brokersalliance.com. You can call us at 1-800-290-7226 extension 147 for any quotes or questions you have on life insurance, annuities, DI, LTC, or group pensions. And remember, I'm not a legal or tax advisor, even though I sound like one. Yes, I'm not one, and always talk to your CPA or attorney before moving forward with any of the ideas that we talk about. And if you're a registered rep and you're FINRA, always check in with your compliance officer before moving forward with anything we talk about before implementing it with your client. Of course, I'm back with Sheryl Moore, the queen of all that is indexing in the United States, the number one authority in the United States for annuities and life insurance in indexing. If you missed the first half of our show, you missed a lot. Miss Controversy here decided to up her game and cause a lot more havoc, wreak a little havoc on the show. Now, I get to do a little havoc wreaking myself.
Ooh, bring it on.
We're talking about illustrations. We're talking about in the first part about crediting rates that we're using for proposals. Okay, fair enough. Well, sooner or later, we want to take this money out because that's one of the features of indexing, which is supplemental income. Now, supplemental income to me, I want to be able to take my money out in the most efficient way. In the old day, I only had to worry about basic issues like withdrawals to basis and policy loans to gain and keep the contract in force on a non-MEC totally compliant contract. Okay, now, today, I'm sitting there, well, policy loans. Do I have zero net cost loans? Do I have wash loans? Do I have spread loans? Or if I'm dealing with a whole life, because sometimes I show that as an income, am I dealing with direct recognition loans? And now I have this new participation or arbitrage loans. And it all matters because some of these loans are very expensive and they can cost the client, I think, some serious money. So talk a little bit about loan provisions, and your program manages this excellently.
Oh, thanks, Steve. I really
I mean, I
appreciate
love this. I mean, I know what I'm getting myself into. Talk a little bit about policy loans on indexing.
Well, you know, back in the old days, we always used withdrawals to basis and then loans. That way we could avoid a tax consequence and still take out the most amount of money possible. Index life was a game changer because we said, look, why do we want to take withdrawals out of the contract? Because any monies that you take out, you're not going to earn indexed interest on. Let's create this new type of loan provision. And at the time, it was called variable loan interest, where the interest rate on the loan is based on the Moody's corporate bond yield average. And what the insurance companies did that offered a variable loan interest rate is continued to credit indexed interest even on the monies that were loaned out. So it was not direct recognition like your old par whole life.
Well, when I think of direct recognition, I always think of par whole life. Now, do you think it's an inadequate description to call participating loans in indexing arbitrage loans? Is that a little misnomer?
I think it's a little misleading. And what you have to look at is what is the actual product and what will it allow, and then what is the marketing of the product or how is it being used. I have a lot of people who use index life or variable life and show it being max funded and then loans coming out in the second year on the illustration because they're pitching it to the client. Here's a way for you to make money by loaning your policy to the hilt. What I'm doing is showing an illustration that's crediting 10% hypothetically every year, but I'm taking out loans at an assumed 6% every year. So you're making 4% off of the policy. Well, what's dangerous about that in promoting a life insurance contract for the loan itself is that you could get 0 crediting instead of 10. And with a variable loan, you could actually end up paying 10% interest instead of 6.
Now, I've noticed that a lot of carriers are moving down into the fixed rate because it can't stay at variable forever. And in fact, I know one of our big players, and I won't mention who they are today, but they're moving in September to make sure that this happens because they are seeing that spread, and people like me bring this up, and then they get nervous.
Yeah.
But when I'm looking at policy loans, I mean, I could get 0 that year, and whatever that loan rate is, I'm paying it.
Right.
I mean,
exactly.
I'm paying it. So there's no arbitrage in that year.
Right.
So what I'm trying to think about, we talked about yesterday about trying yesterday, this first segment, we talked about, 6%, sometimes looking at that indexing as a more midpoint kind of pricing for our illustration. And because illustrations are basically a form of advertisement, or as I call it, vapor on paper, right? I'm curious about, now I'm in distribution mode. Now what should I credit during distributions? We were doing the midpoint was at 6%. Am I doing the same thing during distribution?
Well, I think that's a good question, Steve. And really, this is where the agent needs to do his due diligence in making sure that he not only understands his contract, but he understands the company that he's doing business with and their software. Because what you need to keep in mind is just because the insurance company has an illustration software system that defaults to a credited rate of 8 doesn't mean that the insurance agent can't lower that to 7 if he feels more comfortable illustrating 7. Likewise, if their system is defaulting to a variable loan rate of 5, that doesn't mean the insurance agent can't dial that up to 7 to be more conservative. The variable loan provision really got index life hopping because people say, whoa, I can continue to build a ton of cash value despite the fact that I'm taking distributions. But some people have pulled back and said, well, that's kind of scary to me because I could get zero credited on the contract and still have to pay loan interest. So what we've seen is the insurance companies are kind of trending toward this new type of loan development, and that's a participating fixed rate loan, where it works just like a fixed loan rate where the company maybe declares a rate of 5 or 6%, but the monies that are taken out as a loan continue to earn index loan or index interest.
The index, which I think is more legit.
Oh,
But just a heads up to everyone, because if in a 0 year, you're paying for that money that you're taking out during distribution. And this is where you get back into this whole idea of, should I leave it in the indexing side of it during distribution, or should I park it and see what they're paying? Maybe they're paying 4 on the side fund, and maybe I'm okay with that.
Well, and another thing to consider if you're a producer selling index life is, what is the client's risk tolerance? What is their objective? If they're so conservative that they can't tolerate a 0% in any year, maybe should you be talking about current assumption
Well,
UL?
you just brought up a controversy. You said risk tolerance. Most agents and producers are saying, why are we even talking about risk tolerance? You can't lose anything. There's no beta risk. So now you just brought up this thing, and I was like, everybody, their mother hates this.
Well, I understand and I love the controversy, but I got to tell you, I sat with a lady a month ago where I did not name product, but I talked about, here's your worst case scenario, here's your best case scenario, and basically outlined fixed, indexed, and variable. And the lady picked the fixed profile. She says, I'm not okay with getting 0. I want at least 2%. There are people out there that are too risk averse for index life. And yes, it is nice that you can never lose any money as a result of market downturn, but you have to remember, this is an insurance product. It has charges that are associated with it, and there is a potential with an index life product to have an account value that's much less than what it was the year before.
Well, let's just talk about this. I mean, we have a graph, and again, if you want to order it, you may. We have a graph that shows the S&P at 2001, 2, and 3. Those are 3 back-to-back-to-back years when the S&P went negative.
Right.
Now, it's true, I didn't get any negative creditation on my index. Thank you for that.
Right.
But I still had expense loads to pay. So that means that and people don't illustrate the way I illustrate, and most of the good illustrators in the United States that know how to mitigate costs of insurance by lowering death benefits and switching options and things of that nature. But when I'm looking at the total rate of return, and I'm trying to see what's my number, right? And I'm trying to frame my product line for income. I'm trying to figure out, am I really doing my client a favor with sticking to this?
Yeah.
I'm curious to that.
Well, I'm not a big fan of issuing a contract with an illustration that shows a loan on it and not providing an illustration that shows no distributions coming out, because the client needs to understand this is a tool, the illustration, but we don't know what's going to happen. And so I'd like to provide you with this, which is what we'll hope will happen. But, you can't build that expectation.
I guess if I was all in, I could say, listen, I'll go ahead and I'll import 0 a couple of years, and I'll let the expense loads expose itself to that, because in my S&P example,
Right.
I had 2.5 to 3% compounded loss for 3 straight years in a row.
Right.
Simply because of the expense loads. But just that you're bringing up this whole issue of risk adverse and risk tolerance on an index show like this, it blows my mind, because again, I don't think we talk like that. I don't think we think in these terms.
That is the number one objection I get from insurance agents. I list index life and index annuities as a moderate risk product, and they always fight with me about it, and they say, but that's not true. You can't lose any money as a result of market downturn. That's true, but we have an alternative, and that is a fixed product, and there is a guaranteed annual floor of 2% on most fixed products today, and I think we're getting down to the 1% area, but that is less risky than indexed, where you could get 0.
Yeah, and I think if everybody knows what they're getting into, yes, you can't get credited anything less than 0, but you still have policy expense loads, whether it's admin, front-end load, the cost of insurance, policy fee, those are all still there. They're never going away.
No.
And so if I really was going to be true illustrator, I would show 0 and then let the expense loads, because most of us now have balance sheets at the back of an illustration. Half the country prints them, we do. Half the country doesn't, because I want to see the spreadsheet and what happens in a 0 year. So if I actually did the last 10 years, or actually let's just say from 2000 to 2010, if I did that 10-year decade, and I looked at that 2001, 2, and 3, I'd have to show those loser years, because even though I got credited 0, which I didn't lose anything on the fund itself, I still had expense loads to pay.
Exactly. And, we do have a lot of folks that are so used to saying zero is my hero, but they don't think about the fact that there are insurance charges, and those are going to be deducted. And I think that's part of the reason that I found life specs to be so important, and that's why I had passion about building that system, is because we show you what is the current charge, or what is the current premium load, or the current policy fee, but also what is the guaranteed, because sometimes we know insurance companies do change those.
Well, I love, and I'm all for marketing catchphrases. I love pithy platitudes like, "Hey, zero's my hero." But you know what? If you don't do this right, you're Nero. Okay?
Exactly.
You're a guy out of control, and you're putting the best possible spin on this. And there are aficionados out in proposal land that know how to make these numbers dance.
Oh, there are some that don't even have to work hard, Steve. We do have people who are illustrating double-digit gains on Index 2L today. And I have to urge insurance agents, this is a product where you have a guaranteed floor of no less than zero. If VUL is being illustrated at a gross rate of 8%, why are we illustrating a product that has a floor at a rate that's higher than that?
Well, because we want to beat the VUL illustration.
Exactly.
Remember, heads up, who gave us the flexibility at the field level to do this anyways? Well, all this, when we go into arbitration, I always understand it's really great. The carrier is going to be dragged in for the so-called flexibility on the software program. I mean, that's where it's all going to come down. The field guy, we didn't know it. Did the carrier train us on their product? No. Did he train us on their software? No. Did he train us on reality? Probably not. So remember, all these things are going to come into the thing. And remember, you heard it for Sheryl and Steve. We told you first. If there's going to be E&O issues on this, it's because we are really not doing, in my view, the kind of due diligence on product and the things that we should be doing. I mean, I hate to be, kind of the moral voice here, but I think we need to up our game and really bring this to a whole new level of intelligent due care. Well, of course, you can call me on this. I'll probably get bad email, thebiz@brokersalliance.com, or you can call us 1-800-290-7226, or hop out on our website at www.brokersalliance.com. Well, for Sheryl Moore, Steve Savant, that's all we have on the Business Insurance Zone. That's the buzz on the biz today. Get into the zone, the Business Insurance Zone.
Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.